So the first risk is liquidity. These currencies aren't trading on like an exchange. There aren't spot dealers who will give you access to this. You have to do this through basically a hard currency dealer, meaning that you're actually sending them money and they're sending you the hard currency, the actual bills, and you're stashing them somewhere, I guess. So there is no liquidity. In fact, the way that this plays out into a problem is that even just today's market, so assuming everything that we've got today continued on in the future, well, the difference between what you can buy dinars for, 1,000,000 dinars for right now today, versus what you could sell them back to a dealer, even if you exclude shipping costs, is 20%. So that means that the currency actually has to appreciate in value by 20% in order to get to a break-even point. Well, even from the time of the major disruptions in Iraq, where they threw away the old Saddam notes and they instituted the new currencies that the Provisional Coalition Authority put out, it's only appreciated in value about 23%. So from a war zone to some level of stability we have today has only appreciated 23%. So if they haven't been able to do that in the last few years, what exactly would somebody be basing their decision making that they're going to go another 20% and then I'm in a position where I can start to make some profits? Because right now the spread is extremely wide. Traditional Forex dealer or Forex trader would look at a spread of 1% and laugh. That would be ridiculous. Forex traders pay a fraction of a percent in their spread between the bid and the ask, or the buy and the sell price. The other risk is relative to the impact that a growing economy has on a currency's value. What's being implied here from a dinar dealer is that a growing economy, and the Iraqi economy right now is kind of at a standstill, if it starts to grow, we're going to get an appreciating currency. Currencies don't work that way. It's not like a share price. The value of the dollar is not the same thing as if you were buying a share of the United States. They're totally different. And in fact, here's a great example. Venezuela, Turkey, Mexico all have seen very nice GDP through the late 2000s until about late 2008. And yet we're suffering incredible rates of inflation. In fact, so let's take the Turkey's currency, the lira, eventually reached 1.5 million lira to the dollar in 2007. So what they did was they converted those lira, so 1.5 million of them, you could exchange 1.5 million of them for 1.5 new Turkish lira. So, which, by the way, is now worth 1.8 to the dollar, so it's continued to depreciate. In Venezuela, there's another oil economy, right? And the GDP growth has been better, certainly better than it had in previous years since 2004, and yet you've got the Venezuelan bolivar, which used to trade at about 2,100 to the dollar, is now, they converted it over, so you exchange 2,100 bolivars to the new bolivar, which is now trading at 2.1 bolivars to the dollar. So they didn't actually change its inherent value. What they did was kind of a reverse currency split. They just consolidated those currencies. If you used to hold 2,000 bolivars, you now own 2 bolivars. It's worth the same number of US dollars. So that is a much more likely scenario, is that we'll get an inflating dinar that is then reverse split so that it's a more manageable base currency. In fact, if you think about it, if you're a developing economy, fairly unsophisticated, and you're trying to find the funds to run your government, assuming that some of your support dries up internationally, and at the same time pay back your obligations, which do you really want to do? Do you want to make your currency appreciate and therefore make it more expensive to do both of those things? Or do you want to let your currency inflate and depreciate a little bit, making both of those things a little easier to do? Which is more likely? They're going to run the presses and pay their obligations and pay back cheaper debt with cheaper dinars? Or try to appreciate the dinar for all these speculators out there? I think you know the answer to that question. The third risk here is really what makes this growth argument invalid, and that's inflation. Developing economies typically suffer from what we would call, well, it's definitely inflation, and quite often we'll go through periods of hyperinflation. let's take the Iraqis for example. Their inflation rates right now are hovering between, depending on the month that you look, and this is from the Iraqi Central Bank, are anywhere from negative 4% to 8%, just depending on the month. So you've got inflation rates that are all over the place. Well, inflation eats and destroys the value of a currency. This was the problem in Turkey. So positive GDP growth, inflation rates over 30%. So you've got inflation can offset those benefits that you might see from growth, and it's really easy for a developing economy to fall into this problem, and it's very, very difficult to get out. In fact, the Iraqi Central Bank themselves have said that of all of the traditional monetary policy tools they are trying to build, they don't have any of them that are working adequately yet. So they don't have the ability to, if inflation were to start to take off, they would have no ability to control it. It could turn into hyperinflation like that, and they wouldn't have the ability to do anything about it. So these are the risks that a dinar dealer is not going to tell you about. They're basically ripping you off by not telling you what's the real value of this investment. So get yourself educated, make sure that you're dealing with honest brokers and dealers and looking at legitimate investment opportunities. One of the best ways that I can think of to make sure that that's always the case is to do your research, get educated, and start to practice in the live market.